day, everyone. I hope you guys had a fantastic week. Your first week. Today, we will be looking at Chapter 3 Financial Statements Framework for a Company. So, when we are talking about financial statements, what exactly are we talking about? We are talking about these, for lack of a better word, these documents that are produced by companies, right, in order to see how well they are doing. For instance, in the statement of profit or loss, we are looking at how well we are doing in terms of revenue and our expenses in that specific period of time, right? So that is what our statements are for. They are to see our progress. Are we doing well? Are we maybe just above water? Are we, not surviving at all? Are we going to be liquidated? What exactly is going on in our company? That is what financial statements tell us. Now, the learning outcomes for this specific chapter includes identifying and discussing the different types of companies, presenting financial information on the statement of profit or loss, statement of changes in equity, and the statement of financial position, and then you also learn a little bit about disclosure and notes. Now, just a little background information, right, on the different types of companies. We've got two main types of companies. They are non-profit and profit companies. When we look at non-profit companies, these are companies that have been incorporated, that have been created for public benefit. Not for the benefit of the shareholders, not for the benefit of the directors, but for the benefit of the public. It is to serve. So we look at something like Gift of the Givers, maybe, right? They can be a non-profit company. Then we've got profit companies. These are companies that have been incorporated for the sole benefit of making money, for the sole benefit of financial gain. Now, under these profit companies, you've got state-owned companies, personal liability, public and private companies. State-owned companies are companies that are owned by the government or the municipality. For instance, Eskom, it's owned by the government. Then we've got personal liability companies, in which directors are liable for the company's debt in their own personal capacity. Don't really need to worry about personal liability companies. You will deal more with all of these different types of companies even in Introduction to Law 100 when you are looking at commercial law. Then we've got public companies. These are companies who enlist their shares on share exchange or stock exchange platforms, right? And they publish their statements there, and they also allow their shares to be bought by anyone, right? So they list their shares on these stock exchange markets. For instance, in the JSE, we've got a company like Clicks, for instance. That's a public company. Then we've got private companies. Private companies are companies that are the opposite of public companies. They do not enlist their shares, right? And like I said, you're going to deal with all of these going forward, but mostly in Accounting 100, you're going to be dealing with Pty Ltd, which are private companies. Now, I think we skipped something. Okay. Now, there's this concept that you'll be dealing with throughout accounting, and it is the accrual basis of accounting. There's two types of bases. There's accrual basis and cash basis. Cash basis, it means that you are recording transactions when you get the cash, and in terms of the accrual basis of accounting, you will recognize a transaction as it happens. And by recognize, I mean record it. You'll record it as it happens, not when you receive the cash or the payment, right? For instance, income is reported when we earn the income, not when we receive the actual money. Expenses are reported when they're incurred, not when they are paid out. So for instance, if a customer is coming to buy goods on credit from your company, right, you're going to record the event as, debit receivables and then credit revenue, right? Then your other journal will be your cost of sales, credit trade inventories, right? Don't worry too much about that. Just look at the receivables and revenue part. Just because they bought on credit does not mean that on that day you're not going to recognize that at all, right? It doesn't mean you're not going to recognize it at all. You're going to recognize it because something happened, right? Irregardless of whether you received the cash or not. That is the accrue basis of accounting. So you're going to debit your receivables, credit your revenue, and then obviously your other journal will be debit your cost of sales and then credit your trade inventories. And then when the customer now pays you in cash, you will then de-recognize the receivables account, and then you're gonna have debit your bank. So you're gonna debit bank and then credit receivables, right? Doing like the opposite for receivables, so you can cancel it out. So that's what you're going to be doing. Then we also have another concept which I did not necessarily put it here on the slides. I'm not sure if it's on the other side, but that topic, it's about going concern, or rather that specific what can I say, that term, yes, going concern. It means that you are assuming that this company is going to run and it's not going to end anytime soon, right? So when you're talking about going concern, you're saying that, okay, this company anytime soon, within the next reporting period, nothing is going to happen to it. We are not going to be liquidated. Nothing of a sort will happen that's going to cause this company to end. It's going to still continue. Now, you've got the statements of profit or loss, right? You've got four types of statements, right? The statements of profit or loss, statements of financial position, statement of changes in equity, as well as statements of cash flows. But for now, you do not have to worry about the statement of cash flows. You'll deal with it towards the end of second semester. Now, when it comes to all of these three statements, things that you need to note, especially for exam purposes, is number one, recognizing, or not recognizing, but putting in your dates, putting in the heading, which is the name of your company, as well as the heading, what type of statement is it, and what is the year ended, the date. If you do not have those things, there's a high chance that a marker will not mark your paper, because they're going to say, what is it that you're presenting? We don't know what you're presenting because you haven't given it a heading. So you need to have your headings. Number two, you need to know the format of these statements. When you are being tested, they are going to give you a blank sheet of paper and you have to write the format down. It's no longer the same as high school. You are expected to know each and every single line item. And when we're talking about line items, we are talking about like the revenue, cost of sales, gross profit, all of that. You need to know it, because if you do not, you will lose a lot of marks. So please know your format of your financial statement. And another exam technique is show your calculations. When you're calculating things, especially when you have to put things on a statement of profit or loss, next to the line item, you can calculate as you're going, because they're going to give you different scenarios. And then when you're done, you add it all up. Then you put it, next to that line item after you've done your calculation in a separate row. So, yes, do not forget to do that. And then, refer to your textbooks for more line items and exactly what falls under those certain line items. So let's just look at statements of profit or loss just quickly. So when we're looking at your statement of profit or loss, we are looking at, okay, how much revenue did we make this year? What are the expenses that we incurred during the year? So revenue, you know that your revenue is, the money that you are getting when you are rendering that goods or services that you specialize in as a company. And by specialize, I mean what you usually make on a daily basis, why that company was was originated, right, in the first place. So for instance, if you are a car dealership, your revenue will be coming from you selling the cars, right? Yes, and so forth. Then you've got your cost of sales, which are, okay, what are the costs that incurred for you to, bring, or for you to, bring that stock, right? Which is your part of your revenue. Then you've got, and then also, if you see cost of sales there, as you can see under cost of sales, you've got brackets over here. Please, even here by distributive income, distributive costs, administrative expenses, and all of that, you see that they are brackets. Do not forget this, because if you do, you're going to be marked wrong. What they do in accounting is that they look at the principle, right? So it means that if you don't have brackets, it means that you don't know that these things are reducing, your profit. They're reducing your revenue and all of that. So you need to ensure that you have that. Now, when we look at gross profit is obviously your revenue minus the cost of sales, and then you've got other income. So other income besides your revenue or your income from subsidiary or financial investment. So it includes something like rent income, if let's say you also rent out something, and that is not part of your revenue, right? And then you've got income from subsidiary, income from other financial investments. These two, you don't really need to worry about it. You're going to go deep into it in the second semester, if I'm not mistaken. Then you've got distribution costs, administrative expenses, other expenses. These three are the ones that are grouped. It's not grouped together with this. This is a separate line item on its own. So all of these include like your depreciation, your impairment, your loss after the sale of a vehicle or something like that. Those are the type of things that you have under distributive costs, administrative expenses, and other expenses. Then in terms of financial costs, these are things like your interest that you had paid for on a loan, that type of thing. Then you've got your profit before tax, income tax expense, obviously that is in brackets, and profit for the year. Earnings per share, you don't really need to worry about that much. You will deal with it more when you get to, I think, second semester. I'm not really sure, but you don't have to worry about that for now. Then you've got your statement of changes in equity. Now, statements of changes in equity, what our lecturer used to say is that nobody really cares much about equity, but in this scenario you need to, because they're going to ask you for your equity, right? Your statement of changes in equity. They're going to ask you. So your statement of changes in equity, it's basically a summary of your equity accounts, right? So when we're talking about equity account, we're talking about the shares, we're talking about dividends, we're talking about profit for the year. That's what we're talking about mainly when we are looking at statements of changes in equity, right? And the statement, it reconciles the opening and closing balances of equity accounts during that specific reporting period. Okay, that's what we're looking at when we look at statements of changes in equity. It's actually one of the easiest. It's actually one of the easy statements to remember. So you don't really have to worry too much about it. They mostly ask you statements of profit or loss and financial position, but that doesn't mean that you should ignore it. Go over your textbook, but it's really one of the easy ones. Then you've got your statement of financial position. Your statement of financial position is basically one that includes your assets, your equity, and your liability. Those are the elements that it includes. And then prior year, your statement of changes in equity has got your equity in it. This one, profit or loss, it's got your income and your expenses. Those are the elements involved. Cool. Now, when we're looking at the statement of financial position, you're looking at, your assets, like I said, equity and liability. Now, this statement is a lot to take in, as you can see. So we're gonna look at it not necessarily line item for line item, but I just want to give you like the main crux of it. So you remember, you've got your date, you've got the type of statement that it is, as well as the reporting date, and then you've got your assets. What are your assets? Remember, you learned what an asset is: a present economic resource controlled by the entity as a result of past events. You've got your assets. Your assets are now grouped into non-current and current assets. So non-current assets, these are assets that you're not going to get like the cash amount in the next 12 months, right? And then current assets are the opposite, right? And when you're looking at your non-current assets, you've got PPE, property, plant and equipment. Please write it as full, don't write it as abbreviated. The PPE, or property, plant and equipment, so those are like your vehicles, your machinery, all of that. Then you've got your right of use assets, such as your leases. You'll get deeper into that as we go. You've got investment property, intangible assets, all of that. And then you've got your total non-current assets. Like I said, when you're looking at the question, you do your calculations in your brackets, and then you write your answers under, or like on the further side of your line, next to your line items. Then you've got current assets. Current assets include your inventory, your trade receivables, other current assets, other financial investments. As you go on with the chapters and we actually do the example, you'll be able to see what each of these line items mean. For instance, inventories, that those are like your stock. That's your stock. And then your trade receivables, these are people who literally owe you. Basically, they bought your goods on credit, and to you that is an asset. And then you've got something like, let's say, cash and cash equivalents. That's like your bank account, right? So then you've got your total current assets, and then your total assets is obviously your non-current assets plus your current assets. Then you've got equity and liability. Equity and liability, underneath it you've got your equity, which includes your share capital, share premium, retained earnings. Again, you deal more into detail with it as we go further. You've got non-current liabilities, which include long-term borrowings and lease liabilities, and you've got your total non-current liabilities, in which you're going to add your long-term borrowings and lease liabilities, add them together. Then you get your total non-current liabilities. And then you've got current liabilities, your trade and other payables. These are like things that you bought on a loan. You yourself, you bought them on credit. So you have to pay, those creditors back. And those are trade and other payables. Then you've got current portion of long-term borrowings. Again, you're going to deal with that as we go further. All of that, your short-term provisions, bank overdraft, don't worry too much about that. You're going to deal with it as we go on. Then you've got total current liabilities, right? And then total liabilities is obviously your non-current liabilities plus your current, and then total equity and liability. You add those up together, and that should equal to your total assets. That's how we know that you have balanced and you've done things right. Now remember, you need to know your line items, but if that line item, I think this is what they do, you just need to find out from your lecturers as well, but if that line item is not mentioned, you can like put a dash next to it, because there's no amount that was asked. Sometimes they can even give you a mark for that, but sometimes you can also leave it out, but just verify with your lecturers as well. Now, notes to the financial statements. These are just notes that are basically showing us, okay, when these financial statements were prepared, how did we prepare them? What are those things that you could not necessarily write down on your statements to say, okay, your depreciation was this much, your impairment was on this vehicle was this much. It's giving you the details, right, of what is exactly happening in your financial statements. right? That's basically the all that you need to know. And then you can look at your textbooks as well to inform you on the different notes that you have. You've got like, your profit before tax notes, you've got your PPE notes, intangible assets notes, of which you're going to deal with more towards the end of the semester. So yeah, that is basically what we are looking at when we look at notes. And then what information is included in the notes. You've got your accounting procedure. So what did the company use? Did they use cash basis? Did they use accrual basis of accounting? We're also looking at things like intangible assets. What is the information on the company's intangible assets? Like I said, you've got your intangible assets note. All of those things. We're looking at how were these financial statements prepared? What is the detail, in them? And then introduction to double entry systems. We spoke about this. You will see this in the next chapter, chapter 4. I'm not going to go deep into this. Just look at the format, familiarize yourself with this format. In terms of journals, this is a journal, how it looks, and familiarize yourself with it. And we're going to be dealing with it more in the next chapter. Thank you guys for joining this lesson, and have a blessed day further.